I have begun the recording.
There we go. Thank you very much. Okay. So here we are again. Thanks to everyone who's joining. If there's any new faces, thank you for joining our first session, or your first session, that is. As a reminder, all of these are going to be recorded and posted to the GBC Analytics Club LinkedIn group. So if you miss any or you want to take another look at these, that's where you can find them. So I'm sure you guys are pretty familiar with the schedule, but just to remind you, here we are. Today's Wednesday with session 3. We're going to talk about blockchain's noteworthy use cases. We'll continue tomorrow. We're going to talk about governance. And then next week, we'll finish up with our last 3 sessions. Again, same schedule, Monday, Wednesday, Thursday next week. So I hope you guys will continue to join us, and we'll be done with this before you know it. Okay, so today we're talking obviously about blockchain's noteworthy use cases. We're going to talk about things that exist today, things that are anticipated in the future, and hopefully understand some of the concepts that we talked about on Monday in a little bit more detail. So before we go into the use cases, I want to do a quick kind of understanding check on our previous 2 courses. So we're just going to recap a few things, and I hope you guys will rack your brains a little bit and think about these questions, because I'm going to challenge you guys instead of just reminding you what we learned. So obviously, you guys remember we started talking about innovation and why that's important to using new technologies and working with new technologies. What are some of the principles that stuck with you guys that we touched on in the innovation session? Does anyone have anything fresh that they'd be willing to share?
Insert crickets here.
All right, well, I will give you guys 10 more seconds. No takers?
Maybe if you give us.
I hope that means that you guys are shy and not that you don't remember. I'll give you the benefit of the doubt. But when we talked about innovation, we talked about its cyclical nature, the fact that new innovation creates new requirements for new technologies and new solutions, and how being an expert is not a prerequisite of innovation. And in fact, those with broad knowledge are often best suited to be innovators. I mean, those are kind of important principles that I'm going to probably remind you guys of each session. What about some of the use cases of the internet that we talked about, and what made those things innovative? Anyone feeling a little less shy on this question? Can you recall one of the internet use cases we covered and what made it innovative? No takers, huh? Okay. Well, I'm not going to give you guys an example, but I'll assume you guys remember them well, and if you don't, you know where to find the recording. Now, what about some fundamentals of blockchain? I won't challenge you guys on this one. I'm going to run through these terms again before we get into today's subject matter. But I'm sure you guys will remember on Monday we talked about blocks being just batches of transactions. We talked about why we call it a blockchain, because of the irrefutable and sequential and linear order of blocks making up a chain. We talked about nodes and the software that enables nodes to participate in the validation of transactions. We talked about consensus protocols and how consensus protocols essentially act as a set of rules that help nodes basically validate transactions and produce new blocks. I'll try you guys with one more question, even though you haven't been too chatty today. Can anyone recall the 2 types of blockchain consensus that we covered on Monday? Stake? Yep, proof of stake was the full term, but that was one of them. Good job, Michael. and the other one was proof of work. So we're going to revisit those topics again later later today, so I won't touch on those any further. And then obviously we talked about clients and how clients are essentially users of a blockchain platform or a network that don't act as nodes or don't act as supporters of the infrastructure. Blockchain client, super similar to a web client. Now, we also talked about some pros and cons of centralized versus decentralized systems. You know, some of these key points about absolute control and how some control is often good, but too much control is a bad thing. And how each of these kind of characteristics are require a balance. Limited regulatory oversight. We don't want too much regulation, but no regulation can also be a bad thing too. So the key point here was that no one will tell you that the future is entirely decentralized, but this technology is so exciting because in lots of places in the world, in lots of countries and cultures, centralized systems have created a lot of distrust and dissatisfaction in communities and amongst people. So we're not trying to get rid of centralization. We're just trying to create more balance and more trust in relationships and cultures. And we talked about this process, how to assess blockchain for your idea or your company, how we can try to understand the the transactions that our business requires, to look at the size and the frequency of those transactions, and then use those values to actually figure out what our transaction load is and see if this idea or business fits on a blockchain. So that's the extent of the recap. Now we're going to dive into the new stuff. And we're going to start with existing use cases for decentralized blockchains. Now, why did I say decentralized blockchains? You may remember from Monday that when we look at public versus private blockchains, private meaning permissioned access, not anyone can become a node or a client, then whenever we have that private or that permission-based access, we introduce some form of centralization because some person or some group of people have to control that permission. So there's a difference between public and private or decentralized and centralized blockchains, and obviously we're starting with some decentralized examples. So we have Ethereum, Bitcoin, fundraising, and decentralized exchanges. Let's start with Bitcoin because that's a common one that I'm sure most of you guys have heard of. So the important thing about Bitcoin was it was essentially the first application of a blockchain or a decentralized database. It was the first implementation of this technology that saw widespread use and was understood by the public. So yes, Bitcoin is just a decentralized database, and I hope you guys have a good picture of what that looks like from Monday. And it doesn't have any computational functionality, which we'll look at in some of our next use cases. The Bitcoin blockchain is just a database that records transactions between one client and another. And Bitcoin only exists in the Bitcoin blockchain so that value can be exchanged natively and directly between users of the network. So when we talk about Bitcoin and Ethereum and the idea of cryptocurrencies, there's a tendency to kind of apply those or identify those or even compare those to the traditional idea of what currency is. But the truth is, Bitcoin is really a new kind of means of exchanging value that no one has seen or understood before. So kind of applying that legacy definition of currency to Bitcoin doesn't work for a lot of reasons that we'll get into. But the important point I want to come back to is Bitcoin is just a classification or a denomination of the value that gets exchanged on the Bitcoin blockchain. And if Bitcoin were to, or if the Bitcoin blockchain were to rely on, say, a fiat currency to exchange value, this would introduce a lot of security holes because it's no longer an end-to-end solution. We have off-chain components of the process, and that is inherently insecure. So what Bitcoin introduced or made possible was essentially a fully decentralized payment network. No central bank, no central authority, and no real middlemen. And that was pretty exciting to people and still is. So Tom, if I wanted to send you $100 today, I would do that using an intermediary service like PayPal or Venmo, which are obviously the same companies. And that company would probably take a percent, which is reasonable, but they'd also have to collect some of your data to ensure that they're delivering my $100 to you, Tom, and that I'm who I say I am and you're who you say you are. And because that intermediary has to capture that data, they also have an opportunity to not store that safely or to make that data available or susceptible to corruption or exposure to bad actors. So the idea of not needing that intermediary anymore is pretty cool because we don't have to expose any of our data for a third party to verify. And we still have a little bit of a transaction fee, but generally that price we have to pay to process a transaction is much smaller than it would be if we were paying an actual intermediary.
Nate, quick question, Tom here. Quick question for you. Is that just outsourced to the end user, like using sort of crypto locker type technology? Are they just, or is it the platform's responsibility in the Bitcoin example to be responsible for that?
That's a good question. So if you're acting and transacting in the Bitcoin blockchain, the client, the type of client you're going to use is a wallet application. It could be a mobile app on your phone. It could just be a web application, but you're transacting using a wallet. And essentially your means of accessing your wallet is the only step that the blockchain network takes to confirm that you are you. So when you set up a Bitcoin wallet, you're given a private key. And that private key, you're responsible for storing, keeping safe, and letting no one access it. And that private key is the only thing that proves that you are the owner of your wallet on the Bitcoin blockchain. So that's essentially the verification present on the Bitcoin blockchain. Does that answer your question?
Yes, it's exactly what I thought. Thank you.
Cool, no problem. And that's not to say it's the perfect way to do this. You know, there are definitely steps that we could take to add a little bit more security or even more convenience, but we'll get into that stuff later. So okay. Bitcoin, I'm sure, probably sparks the question, well, how much is it worth? Is it worth anything? And this really sparks the debate of, well, is Bitcoin a currency, like we talked about, or is it an asset? Does it have inherent value in and of itself? And the answer to that is not simple. And it's not something that we're going to delve into too deeply today because we have a whole session dedicated to talking about cryptocurrencies and economics. But the important point is that while Bitcoin may take some form of a currency in some scenarios and may take the form of an asset in others, it really needs a new working definition and even a new set of language to really understand what Bitcoin's purpose can be in a blockchain-enabled platform or network. So if you're still a little bit confused about the currency and asset debate, don't worry, because we're going to get into that on Monday, like I said. But as we move on from Bitcoin as our first decentralized blockchain use case, the important point to take is Bitcoin was first, obviously, and it enabled the first decentralized, fully decentralized, that is, payment network. And that's pretty cool. Next up, we have Ethereum. And yes, Ethereum was second after Bitcoin, as you may remember from our evolutionary curve on Monday. Now, Ethereum was unique and noteworthy because it was also the first to do something. They were the first programmable blockchain. And Ethereum actually created their own programming language. That allowed clients to write their own cryptographically secure programs. And yes, if you haven't guessed, that's what we call smart contracts. So a smart contract, we all know what a traditional contract is. A smart contract is essentially a disintermediated contract. And Ethereum smart contracts were introduced to enable everyday people to design cryptographically secured programs on the Ethereum blockchain. Now, this led to a lot of interesting things that we'll cover on Monday, a lot of business cases, a lot of things people tried to do and didn't do successfully. But what was exciting about this is this programmability. It let people create their own, essentially their own mini database or mini blockchain within the Ethereum blockchain. And this is really what kickstarted the adoption of the Ethereum blockchain and the generation of so many other cryptocurrencies. And the only reason for that was, if I'm going to create my own mini blockchain within the Ethereum blockchain, then I need a way to classify my transactions. And that's pretty much all a token is. It's a record of which wallets are holding what with respect to the smart contract that governs that mini database or that mini blockchain. So that kind of, as I'm sure you can see, makes our definition of what's a cryptocurrency a lot more complex. And again, we'll get into more of that on Monday. But the point here is Ethereum was the first decentralized solution that had programmability built into it. So if there are any developers here who have taken a few semesters of full stack or technology courses, if you've ever written the ATM program, just as a piece of coursework, that's an extremely similar type of contract or type of programming than smart contracts are. The only difference being smart contracts have the benefit of cryptographic security, just like a database does, a blockchain database. So again, just in case I was talking too quickly, the takeaway here, Ethereum was the first implementation. Sorry guys, I'm having my Siri turn on. I was not shutting off my microphone. Ethereum was the first implementation of digital programmable contracts secured by the same cryptography that secures basic transactions in a blockchain network. So our next one that we're going to cover, existing decentralized blockchain use cases, is the decentralized exchange. So when you guys hear exchange, you probably think currency exchange at an airport or stock exchange. And how do we look at decentralized exchanges if we aren't really sure if cryptocurrencies are currencies or assets? Well, we have to ask and kind of look at how people use cryptocurrencies. Now, whether or not people are exchanging using cryptocurrencies as a currency or as an asset, the fact that there are other stores of value is going to create the need to trade or exchange these different currencies. So that's why cryptocurrency exchanges came about. Now, before there were decentralized exchanges, there were centralized crypto exchanges. And any of you guys who have read about the history of blockchain will probably know about the very famous exchange hacks that led to hundreds of millions of dollars of people's own money being lost. And the reason for that was that a centralized exchange still stored all of their users' information in a centralized database, which I hope you guys remember is susceptible to hacking. And that's exactly what happened. So it was really unfortunate that these first businesses that came into the blockchain space to provide what they thought was a service didn't really go about it in a thoughtful and diligent enough way that they could prevent what happened. And so the decentralized exchange was essentially the solution to those big hacks of the centralized exchanges. And excuse me, what's significant about the decentralized exchange is it allows people to buy or sell a digital currency without requiring the buyer or seller to disclose any of their identity information to the other person. It's the same as a decentralized payment platform that has been disintermediated. We no longer have a middleman or an intermediary that has to secure or process the transaction on our behalf. We're going directly from client to client. And that's the basic principle of why decentralized exchanges are much more secure and much more favored by people who already use digital currencies today. And you don't have the luxury of that privacy in traditional banking or even trading stock markets, because those types of intermediaries still use identity verification and require other sensitive personal information in order to do their security checks. But blockchains and decentralized exchanges do their security checks without all of that. So a decentralized exchange is essentially a programmable blockchain that uses that cryptographic security to enable users to buy and sell peer-to-peer without any intermediary. So our fourth existing decentralized use, sorry, let me read your message, Tom. Exactly. Disintermediation, that's the key. So our fourth example of an existing decentralized blockchain use case is fundraising. Now, this is looking pretty small here, so I hope this is clear enough that you guys can see. But the slide you're looking at is just some quick facts about the ICO. For those of you who don't know, ICO stands for Initial Coin Offering. And the first ICO came into play when Ethereum sold some of its tokens in order to fund the platform's development. Tokens weren't sold with any equity backing them. They weren't securities. They were just sold by the founders of Ethereum, the founding developers of Ethereum. They were sold to early adopters and evangelists who they expected to later use the Ethereum blockchain and later have a need to buy Ethereum currency. So the Ethereum guys figured this out, and they said, well, what if we offered our tokens at a discount and got some money into the project before? And what they realized was blockchain is really a great solution to lower the barrier to entry for investing into companies. It makes it easier for companies to reach a broad audience, and it makes it easier for individuals to access a broad range of investment opportunities. But as you may suspect, the lack of regulation and the speed at which this technology caught fire back in 2016, it led to a flooding of the market, and essentially it led to a boom and bust episode. Once people realized that there were bad actors taking advantage of this, coming into the space to basically manipulate the excitement around the economic growth and development of blockchain, this kind of led to a extreme distrust in blockchain that was really prevalent for, I would say, up until last year and even present. And this is a really good example of why, when we look back at our pros and cons of decentralized versus centralized, we do need a little bit of regulation, because there are always going to be people who have bad intentions, and they're always going to have creative ways to take advantage of people. So, Tom, I'm sure you've probably already made this analogy or this tie already, but this was kind of similar to the late 90s in the dot-com bubble. Even institutional investors were throwing money into internet companies just because they said they were using the internet. No one really understood what the internet was until the dot-com crash. And everyone realized, wow, there is a lot of inflated value in this technology, and we need to come back to the fundamental value. And that's the exact same thing that happened with ICOs. Tons of excitement, investors flooding in without truly understanding the technology. And without the ability to understand the technology, no one could really do effective due diligence on and decipher which projects are quality and which projects are scams, for lack of a better word. Right. Good one, Tom. Okay, so those were our 4 existing use cases for decentralized private blockchains. And one of the big questions that people ask about blockchain is, when will we see global adoption?
Public
When will this
blockchain,
become...
Nate.
Sorry, what'd you say, Mark?
Public. You said private.
Oh, I'm sorry. These are our 4 use cases of public blockchains. And just to finish that thought, whether you're a skeptic or newly interested in it, you have the question: when is blockchain going to become an everyday technology and globally used and globally relevant? And the thing I want to point out is we're not quite there yet. Bitcoin has hundreds of millions of users, but it's not quite. We like to say that a billion users, obviously globally spread out, is a pretty good threshold for achieving global adoption. And we're not there yet with Bitcoin. And we may get there, or a better solution may come about that becomes globally adopted and globally relevant before Bitcoin does. We don't know, and I don't really think it makes sense to spend time trying to predict, because there are plenty of tangible and practical solutions that we can focus on right now. So let's look at some existing use cases for private blockchains. Just to quickly remind you, private blockchain, permissioned access, often introduces centralization. Always introduces centralization, actually. I should qualify that. Just the extent of the centralization is variable. So a centralized blockchain, that doesn't mean that the blockchain provides no value to the business or the customers, but it does mean that we have to be pretty careful in who we give control of that permissioning process, what rules and criteria we set around access to the network, whether it's clients or nodes or some other stakeholder. And so these are really important design questions that you have to consider when you're going down the path of a private blockchain. Now, IBM is a company who has taken some pretty serious initiative. We'll stick on this one for now. Taken some pretty serious initiative in implementing private blockchain solutions for other businesses and even large enterprises. And the primary blockchain that IBM uses is called Hyperledger. Hyperledger is its own blockchain. It's actually based on Ethereum. And Hyperledger is designed to support private blockchains of IBM clients, similar to the way Ethereum lets you build your own mini database. IBM Hyperledger lets you build your own mini database, but with a predefined set of rules and criteria that IBM has figured out generally help and apply to most businesses looking to implement private solutions. Now, this is a pretty good, hopefully not too technical description of an IBM Hyperledger implementation. We have a larger ledger over here to the right. We can consider that the IBM Hyperledger blockchain, or even the greater Ethereum blockchain. And we can see that this specific use case, let's say this is for General Motors, we have a dedicated set of nodes and peers that are responsible for validating transactions. And all the way up in the top left, we see that we have a permission user. This is the person that governs permission within the system. This is the person that says whether or not Alice can run an application or Bob can send a transaction. So this is just a general kind of visualization that I hope was valuable to you. But there's a challenge here. It's not impossible to say I'm GM. It's not impossible for me to find relevant stakeholders to support my infrastructure. Remember, GM has their own nodes supported by their own stakeholders. It's not impossible for GM to go to each of their stakeholders and their manufacturers and say, hey, we have this awesome new supply chain technology, and we would love you to run a node. That's not hard to do, and it's actually, a great way to do a check-in on all of your partners. But the problem is most companies don't have enough expertise or don't have anyone in their leadership that understands the technology. And that's kind of where IBM has thrived, is being a consulting partner for these companies and providing that technical expertise that helps them set up their infrastructures or design their infrastructure based on their capabilities. So any client that uses an IBM Hyperledger solution doesn't have much power in the network as a whole. It's not a decentralized system, so there isn't that fundamental or underlying trust that a fully decentralized system has. And that's okay. It's just a drawback of a private solution. And let's look at why we might go about the private solution versus being General Motors and implementing a public blockchain. So let's say I'm GM and I want to secure my entire supply chain with a blockchain. I could go to each of my manufacturers and get them all to set up a node, teach them about the technology, and get my blockchain up and running. Maybe I have 50 to 75 nodes running that are spread across both some in my company and spread across different stakeholders. And because I can control the number of nodes, I can also control the connection of those nodes. GM could very reasonably invest in high-speed connections for all of their nodes. If you remember from Monday, this means we can have a higher transaction throughput if we have a controlled requirement for internet connection within our network. But what about looking from the manufacturer's perspective? If GM comes to me and I'm a ball bearing manufacturer for GM's wheels, and GM says, hey, we want to set up a blockchain. Here's how to run a node, and spend a week working with GM to set up a node to participate in GM's brand new supply chain blockchain. But what about when my other customers come to me? What about when Ford comes to me with their blockchain solution? Or when a bicycle company comes to me and they have their blockchain solution? We have a much muddier picture now, and it's not as elegant of a solution as it seemed when we just looked from one industry player's perspective. And this is one of the things, not the only thing, but this is one of the things that has hampered the effective implementation of blockchain supply chain solutions, is that while private blockchains enable us to control things that are important, they also introduce significant threat and burden on most other participants in the network beyond the designing or sponsoring company, in this case GM. There's another less technical but still valid reason that apply to most supply chains that we've heard about. Let's take the example of a diseased chicken. I don't know if this chicken's sick or not, but he looked like it. So let's say I'm a chicken company and I have a blockchain solution that is tracking a chicken from egg to dinner plate. And my goal is to make sure that no one who eats chicken gets sick. Let's look at what purpose the blockchain really solves and really run through this as a use case. I eat chicken and it makes me sick. So assuming I am familiar with the blockchain solution, I go on and I create a report to the system. The system knows what restaurant or store I got my chicken from. And once it figures out the source, it can backtrack the chicken and find out where the chicken came from and where the rest of it went. But what about all the chickens in the world? There are 137 million chickens killed every day. That's 1,600 chickens killed every second. Even if we are only recording transactions of when a chicken was killed, that's still a pretty heavy burden on any blockchain network. But we also have the transactions to record when the chicken is shipped out from the facility. And then the butcher's transaction that turns one chicken into 20 different units. So now, even just there, we're looking at 32,000 transactions per second. And the chicken industry doesn't sleep. Chickens are always being killed and butchered and distributed. So this is a weird example, but this is hopefully illuminating in that even if a supply chain solution may sound simple and feasible, there are most likely many more transactions required to provably and effectively get the job done, prove what you're trying to prove, in this case, healthy chickens. Much more transactions than you could imagine in order to do that. So let's look at this now. Anticipated use cases for decentralized blockchains. We've looked at a few that are prevalent today. Now let's get into some anticipated ones. We talked a little bit about art authentication on Monday, and this is an interesting example that I like to use. So let's get into this one more time. Let's say I am an art gallery. I have 100 paintings, and I want to prove to the visitors of my gallery and potentially the customers of my work, I want to be able to prove that these pieces are authentic. I could design a blockchain solution that utilizes a human art authenticator, and that art authenticator could basically create a record of, say, 15 to 20 extremely unique characteristics of the painting that the specialist, the authenticator, would know those are extremely hard to fake. And the authenticator can then create a blockchain record that stores those unique characteristics of the painting and ties them to a basic ID. So now the gallery owner has a record of their work, and like we say, if I'm a visitor to the gallery, I can take a look at the record and see that this piece of art is authentic. Or if I'm a prospective buyer, I can do the same thing. The problem is, what if some of those characteristics change? What if humidity, age, or any other number of factors influence those characteristics? And I don't have a specific example for you, but this illuminates the problem with tracking real-world assets using an on-chain record. It's really hard to create an irrefutable link between these two things because, as we just seen, the real world changes. Blockchain is just zeros and ones. So an art authentication platform, I would say, in his example of a reasonably viable use case for a supply chain that takes intense design and extreme research within an industry to understand all of those aspects about the authentication process, the criteria for an authenticator, and all of those little things that we really need to understand deeply before we go out designing an immutable ledger to support a process. Now, similar to art, we're going to look at a use case of real estate. But before we talk about real estate, stick on the art with me for a second. Can anyone tell me what might else be possible when we create blockchain records of fine art? Is there any new way we may be able to sell these things? A new way to interact with them? Does anyone have any ideas? IoT. What do you mean by IoT, Wanya? Auctions. Auctions is close. I'll run with that one, Ali. When we create a blockchain record, because it's a digital record, it's not a real painting, we can fractionalize it, which means a gallery who owns their art, some don't, a gallery can sell 40% of everything on their wall while retaining ownership of it, but it can allow people to participate in investments into art just like they invest in any other collectible or commodity. And the same principle applies to real estate. And that's why a lot of people from traditional business have jumped into blockchain, is the opportunity to introduce fractionalized real estate investing. There have been a lot of use cases of this. You can find a lot of things to read about if you just Google fractionalized real estate blockchain. And if we think about this, it's a pretty cool concept. But there is one problem that I'll mention. Let's say I live in Toronto with you guys, and there's a new skyrise being built. And that skyrise has a fractional blockchain fundraising mechanism, which allows me to buy 1% of that building. That's great because I've lowered the barrier to entry by making the amount I need to invest in a traditionally pretty restrictive commercial real estate space. I've reduced that barrier to entry by saying I can put in $5,000 instead of 5 million. But there's a really important problem which real estate people won't tell you, and that's the problem of liquidity. Even though we've lowered the barrier to entry and made it easier and cheaper to invest in traditionally challenging real estate things, that may not be a good thing, because those of us who don't have enough money to make larger investments are probably pretty strongly correlated to people who may need liquidity in the future. Liquidity means I need out of my investment. Who can I sell this to get my cash back, or at least hopefully some of my cash back? And this is not a piece of the fractionalized real estate process that has been thought through. And there may not even be a solution to it, because if you think about it, if I enable 1,000 different people to invest in my commercial real estate platform, they're not seeing a return on investment until that thing is built. So the fractionalized real estate is a cool example, but there's definitely going to take some work in order to refine the process to make it sustainable, I believe. Again, feel free to ask questions. I know I've been going pretty quickly through these. So what about consumer payments? When we look at a consumer payments platform, there are a few different potential value adds when we consider a blockchain-enabled payment platform. The first is privacy, just like we talked about with exchanges. If we don't have any intermediary present to collect your data to verify a transaction, then you don't run the risk of that personal information being exposed, either intentionally or accidentally. And the second one, which is equally as important and popular and talked about, was kind of part of the original vision of Bitcoin, which is that no centralized body, whether it's a bank, a government, or something else, can freeze your account. Once money is in your wallet, no one can take it from you without literally putting a gun to your head. And that's pretty exciting. We have the luxury of living in developed countries where we have banks who are able to, most of the time, protect our money. But there are lots of countries in the world where that's not the case. We can look to the Middle East, countries like Lebanon. We can look to South America, at Argentina. You name it. Those are places where they don't have the luxury of trusting their bank, and where a payment solution that allows me to provably and completely protect my money, that's a major value. And we're going to look at a recent news story of that a little later on. What about music? I know this is a little bit small, but if this is clear enough for you guys, I'm sure those charts will give you a hint. But can anyone tell me what value a decentralized music distribution platform might offer the industry? I'll give you a hint. It has to do with intermediaries. easy to sell rights to small artists. Streaming services, protect artists. Those are all interesting points. Wanya, I'm going to start with yours. So before the internet rolled around, music was what? CDs, records, tapes. And because of the nature of how music was bought and sold, it was a little bit easier to manage the rights and the royalties of that revenue. When music became digital, we went from buying CDs to digital distribution, streaming, all day, every day. So what happened was the transaction volume of the music industry skyrocketed. But the problem was there were centralized control, centralized entities, major record labels, and the major distribution providers, which were the streaming services. They used their control, and their control was developed through the amount of artists that they hold in their companies. They used their control to not create any new protections for artists. They've basically applied the paper-based accounting system from the CD's day and tried to make it work for streaming. And what that's led to is extremely inefficient. Artists have no transparency or even rights to see what the flow of money is. These intermediaries take massive cuts. So this is transaction fees on steroids. And generally there's no sign of any of this stopping. So we don't want those labels and streaming service to go away. But if we did have a decentralized payment and rights network that we could apply to the music industry, there is an opportunity for all of these different stakeholders to act and exchange more equitably between one another. And this is one my colleagues will tell you that I'm particularly looking forward to seeing. So we have one more. Again, we're looking at anticipated decentralized blockchain solutions, and that's digital identity. So we talked about how data privacy comes into play with exchanges or consumer payment platforms or even traditional fundraising processes. And the privacy concerns come into play because intermediaries don't follow effective or safe practices to protect your data, or they simply can't because there's no foolproof way to protect centralized systems. But what if there was a blockchain-based platform that contained certified proof of your identity and allowed you to interact with entities or governments or other people who require verifiable proof of identity without actually having to disclose it? If I can point to a provable record of something, someone else can trust that record without necessarily needing to see what's behind it. So why wouldn't the company want to see what's behind it? If I can sign up for a bank account without telling the bank my name, simply pointing to a record that proves each of the personal information that the bank asks for meets their criteria, the bank knows I'm following the rules, but they also don't have to worry about running the security systems to protect that personal data because they aren't storing any. So this concept of digital identity is a huge shift from the way things are today. And as we've seen with banks, they're not the best at adapting and innovating. So this is going to be a tough one, but it's an extremely valuable and concrete solution and application of blockchain that we all see at BlockBox as one of those fundamental building blocks and pieces of infrastructure that the industry really needs to move forward. And that's basically the disposition of blockchain-enabled digital identity. So I know we've covered a lot, but we have one more category to look at, and that is anticipated use cases of centralized blockchains. How many of you guys have heard of the Libra project? A couple of you. Cool. I'm not surprised. It was all over the news a year and a half ago. And for those of you who aren't familiar, Libra was call it a project or an initiative started by Facebook. And their idea was to have one borderless currency that anyone could use to transact. And the idea was that single currency was actually underpinned or pegged to a basket of all the world's leading fiat currencies. Now the problem is that it was pegged to a managed basket of fiat currencies. So I hope the question has come to some of you. Who was managing the basket? That's a concern that's a centralization concern of Libra that no one even got to address because Congress shut them down. So for those of you who heard of Libra, why did the SEC and US Congress shut down Libra? Wasn't in their statement, but I'm sure you could have gleaned it if you read. Anyone have an idea of why they shut Libra down? It's because it threatened the dominance of the US dollar, which is pretty important to the US government. Now, what do you guys think Mark Zuckerberg did wrong in this scenario? They went out, they got all of these companies together, literally all of these companies, and they said, US government, this is our plan. Can any of you think about what was wrong with that situation? No? Okay. This is the classic beg for forgiveness, don't ask for permission. These long-standing intermediaries, banks, governments who rely on their centralized control, they're not going to let a company like Facebook come along and destroy that. So that's a kind of off-book question and answer, but it's the truth. As innovators, we need to understand who it's a good idea to ask permission and who it's a good idea to understand the answer is going to be no and still believe in the value of what we're doing. So hopefully Mark Zuckerberg learned his lesson there. Yes, he does, Tom. So staying on this topic of banks, what about a central bank owned digital currency? Here's some quick facts about central banks and their interest in digital currencies and blockchain. So why are governments interested in this? If what we just said is centralized institutions don't want to give up to decentralization. The answer is pretty simple, is they want full and utter control over money flow. They recognize that blockchain is a technology who has the opportunity to threaten that. And they realize that if they move their monetary system into a digital currency that they can control, that would be a private blockchain, they can do a couple things. Obviously, they can retain control. They can begin collecting microtransaction fees, which central banks don't get to do right now. And they essentially eliminate the black or gray or the non-taxable transaction. They have their eyes and ears on everything going on. So this is a pretty big value to a central bank or a national bank. And obviously, it destroys and breaks the original vision or value for blockchain, which is that once someone pays you, it's yours and no one can touch it. With a central bank digital currency, we're back to square one. The central bank has control. So any news or media you see about these talks with central banks and legislators and government officials, in most cases, this is the kind of disposition or objective is, let's create the illusion that we are moving to a more equitable system. But in actuality, we're sticking to our guns. And this is that article I wanted to tell you about. And this is a great example of, it substantiates everything we've learned today. I can find this link and send it to you guys, actually. Pop it in the chat here, 1 second. This is just a great example of, in countries and in regions when people don't trust their banks and trust their governments, a decentralized payment network is of huge value. And it just goes to show you that this idea of central bank digital currencies is so wrong and backwards in so many ways. Not to say governments shouldn't be involved in the regulations and policies around the currency their people use, but they shouldn't have absolute control. And that's the balance we need to find before any of these initiatives will work. So our last use case, Ripple, which some of you may have heard of. And Ripple's objective and kind of initiative is pretty simple. They want to be a borderless, essentially become the backbone for global remittances, whether it's institutional or consumer. And this is a very broad goal, as I'm sure you know. Ripple was very early on in the evolution of blockchain. It almost came right after Bitcoin and Ethereum, a few years after. But they've gotten some real traction in doing this. Several institutions are using Ripple to conduct their remittances, but Ripple is private. And anytime we have a private blockchain, we have questions about who's in control, what are their objectives, and also what are their values and principles that they're going to govern the system based on. So the general consensus about Ripple is they probably won't achieve their goal. In my opinion, it's an early implementation or an early attempt that will teach others to do it the right way. But the centralized nature of Ripple makes it really challenging for it to be the people-pleasing solution that it aims to be. So I know we just covered a lot. I hope that wasn't information overload. Can anyone think of any either anticipated use cases, any ideas that you've come up with, business solutions, or any existing ones that you thought were interesting that I didn't cover? Does anyone have any ideas or concepts they'd like to share there? Or questions? We're all done. So if you guys had questions or want to revisit something, I'm happy to. Alex, that's a great question, and you're lucky, I hope. Meyer, do you want to take this quantum computing question? I can give you a short answer, Alex, but Meyer's will be better.
No,
Go ahead, Meyer, whenever you're ready.
The straight answer is no, because blockchain technology. The straight answer is no, considering there are quantum proofing solutions out there for blockchains that we've actually spoken to in the past as well with, and generally speaking, quantum computing just gives you the insane amount of computing speed that you're looking for, but there is still other variables you can use to actually make sure that any quantum attack vectors are not going to be the ones that break through your key pair.
So was part of that quantum computing has the capacity to reduce the bandwidth limitations, increase transaction capacity generally? Right, Meyer?
Yeah, and
cool.
Absolutely. And For the next one, there's actually a pretty interesting project they should look into named Power Ledger.
That's a good one. Power Ledger is Australia based, right? That's the one I'm thinking of, right, Meyer?
Yeah, that's the one.
So yeah, Wanya, check out Power Ledger. I'll try to find the link for you actually right now. It's a pretty intriguing project. And Wanya, we've actually worked with several energy clients and talked about various solutions. So if you have any ideas or questions after you check out Power Ledger, feel free to ping me on LinkedIn. Sure. So obviously we're going to continue on tomorrow. We're going to talk about governance, both how blockchain can apply to the governance we experience every day, and also what blockchain governance is. So I'll stick around if anyone has any more questions, but we're finished with our coursework for today. So if you don't have any questions, you're welcome to take off. But like I said, I'll be here for another couple.
This is Tom. Tom's jumping in. I just wanted to say hi to everybody, and thank you, Nate. That was a great session, of course. You know, we're learning a lot about blockchain and everything like that. Really appreciate it. Tomorrow is Nate's next session. I think it's session 4, isn't it, Nate? It's session 4?
That's it, session 4, yep.
Yeah. So we're continuing tomorrow, May 7th from 3 o'clock. I want to, hi Fateh, how are you? I want to just remind you as well, those of you in B412, that we have our graduation ceremony thing on Friday. I got to figure out how to do a rave, so that's funny. Anyway, and also we have seen that we have notification that Blackboard is going to be shut down between, I think, the 8th and the 13th or something. Oops. And so the information regarding some of the next sessions that you guys are having may change to a different platform like Zoom or something like that while Blackboard is going through maintenance. But for tomorrow, it's continuing Blackboard, and we'll see you guys all for that session as well. Nate, thank you so much. Appreciate your time. Appreciate everything.
Of course. Thanks for joining and coordinating, Tom. Good chatting with you.
Yeah, you too. Everybody, thanks, Anissa, everybody, Alan, everyone else that's come in here. Appreciate everything. See you tomorrow.
Hey, Nate, do you have an idea if Airbnb implemented or not on blockchain? Kevin, are you asking if they've tried to do it before? Or if
I think they tried, right? They tried, but they didn't.
I know that they were researching it. They were talking about it. I don't know if they ever actually went to any beta implementation.
Okay.
Mark, do you know anything about Airbnb's blockchain?
They're still doing it.
Yeah.
Okay. I got it.
They're still doing research on it. Their problem is the same as it would be with Uber and supply chain in general, because when you think about it, putting Airbnb is in of itself a supply chain solution, right? And so is Uber. They're both supply chain solutions that are, just instead of going to single or aggregate providers of resources, they went to point. They crowdsourced their resources. And the problem there is that you've got millions of suppliers. Airbnb's transaction load is lower from a transactions per second level, but the content of their transactions is higher. There's just too damn many. How many Ubers are engaged at any given second?
Right.
In the world, right?
Okay. Well, thanks, Marco.
Yeah, no worries.
Sure. Of course, Kevin. Thanks for joining.
Okay, I'm going to actually stop the recording at this point.
Okay, perfect.
Sounds
Thanks,
like a
Tom.
plan.